Bimbath, Conch Economist here. What follows is part two of the interview I had with Mr. Grant Couch after the market closed on Friday, February the 20th. If you haven't tuned in to part one, please do so. It's also very interesting. Thank you for watching. But there were several things that happened this week in addition to the Supreme Court ruling today, and that has yet to be played out. As we sit here right now, we don't know what the refund mechanism, if any, is going to be. We do know that the president is trying to use some other powers to impose at least short-term tariffs. I think I heard it was 10% in some other policies that, or some other provisions of law that he can use.
122.
Yes, but there were some other events this week that also are worth considering. For example, we got some inflation data, which really didn't show a strong trend one way or the other. So we're clearly not at the 2% inflation goal, but apparently we're not edging up too much toward 3%. Something that I have watched and that I have talked about before is the interest rate for mortgages, and that we usually expect some type of maybe a 2-point premium above the 5-year of the 10-year bond. Or note, and yes, okay. I know I sometimes use the word bond. A 10-year obligation of the Treasury is technically referred to as a note. Grant has corrected me on that, but whatever it is, it's 10 years and it's an obligation of the U.S. Treasury. And historically, and even to the present time, we see about a 2-point spread between what we pay for a mortgage, and I'm talking about a 30-year fixed mortgage on a homestead, as well as the bond. For example, right now the 10-year bond is yielding just a little over 4%, and not surprisingly, the mortgage rate on a 30-year fixed is a little over 6%. Do you see any hope for the 10-year bond to get below that magic level there of 5%? Do you think we're going to be able to get to a 5% mortgage rate this year?
I'm looking forward to talking about mortgages because that's the area I specialized in for 20, 30 years. But I do want to just step back for a second, if I may, Merle.
Yeah, please.
On tariffs. One of the things that is so challenging with the way this administration is dealing with tariffs is they're not being used exclusively to adjust prices between goods, to limit imports or expand our exports. They're being used, in my opinion, in a vindictive way to affect policy outside of trade.
Yes.
And I mean, it's a brutal weapon for that, and it's really just imposing, in my opinion, a tax on middle America and lower income America, because the price differential on tariffs means nothing to upper income people, in my opinion.
And these were the kinds of things that Adam Smith was addressing in his famous book of called The Wealth of Nations. Interestingly enough, published in 1776. I've said that there were two very important documents in 1776. One, The Wealth of Nations, which laid the theoretical foundation for capitalism, and of course our own Declaration of Independence. And both of these were declarations of independence in their own way. The one that Jefferson wrote had to do with political and sovereign independence, and the one that Adam Smith wrote had to do with economic independence. Anyway, the tariff issue is yet to be resolved. I don't know that it's going to be resolved during the president's tenure in office. I think down to his last day in office, he's going to be talking about that.
That's a question. It'll be interesting to see what Congress does.
Yes.
But I'm so glad you reminded everybody that the Declaration of Independence and the Wealth of Nations were in the same year.
Same year.
Because those are like two pillars for me.
They are. They
they're so.
They both are proclaiming freedom, freedom of choice, and freedom of expression, and you know, a market of free products is hard to separate from a market of free ideas.
Yeah.
The two go hand in hand. If you want freedom of ideas and freedom of expression and freedom of speech, it's hard to have that and still not have free markets where people also have a choice of not only what they say and where they worship, but also where they shop and what they buy.
Yeah, well said.
Where they work.
Maybe we can both agree that 1776, because of those two documents, are in fact when the Age of Enlightenment started.
That's a very good point. Yes, it was an enlightened time, that's for sure.
Yeah, yeah.
But before we wrap up here, just let
Yep.
me
I'll
pick.
get back to mortgages real quick.
Yeah, let's because my audience is very much interested in that. I have seen the demographics, and apparently I do get a fair amount of young viewers on this program, and I've had a series on how to buy a home here in 2026. Of course, one of the linchpins on that is the mortgage rate. So, uh, as a Wall Street expert and veteran.
Veteran, I'm not sure about expert. I survived.
You survived. Hey, that's the test. What's your outlook for
So
mortgages?
my outlook is I think that we will have higher interest rates. I think that there's going to be inflation, despite today's number of that was somewhat ambiguous. I don't think that what's going on with defense spending across the world, certainly here and in Europe, and we know or understand that it's very much the case in China and Russia, um, that with this defense spending, with this confusion over tariffs, with the challenge of the price of beef is going up a lot too, and you can look at the reasons for that.
Well, as I understand, it's because we don't have enough cows. We have the same number of cows today that we had years ago when we had half the population. That's my understanding.
And one of the reasons that we don't have the cows is because the basic breeder farms don't have the rain they need to support
Right.
the
There's been a
herds.
drought in Texas.
So there's all kinds of pressure, I believe, that's going to send inflation up. When inflation goes up and it's actually finally received and understood, perceived by the market, then rates go up.
Yes.
And if the foundational rate, which you're correct, is the 10-year note, in my opinion, the mortgage rates will price off of that, and they're going to go up. So if I were thinking of buying a house now, I would be happier. I don't think it would be a mistake to grab the 6.15, 6.25, 6% rate if you can get it. One of the things, though, in terms of mortgages, when I was deeply involved in the mortgage market, there were adjustable rate mortgages. There were mortgages that had no interest rate for the first 2 or 3 years. There were mortgages that stepped up. There were all kinds of games to play, which caught people when rates went up. And there's lots of tricks in mortgages. The thing I would counsel your folks that are thinking about buying a house and trying to figure out the mortgage things is that really, really research what your risk is.
Yes.
And it's so easy. And I remember, even though it's a long time ago when I was young, I was thinking about paycheck to paycheck, month to month. And I remember when I changed jobs at one point, they started to tell me, and I was all of 28, they started to tell me about the pension plan. I'm thinking to myself, pension plan? What's the salary? Pension plan, vacation and salary. That's all I cared about. So
paid vacation.
Paid vacation. Yeah, paid.
Yes,
Yeah, that's true. Yeah. Yeah, not paid time off.
No,
I don't care.
paid vacation.
So the counsel I would give is there's so many opportunities to make a mistake. That isn't to say you shouldn't take a mortgage, because clearly you need to when you want to buy a house. And I think it's still proven, if I might ask the expert, that the best investment that middle America can make for their future is to buy a home.
Yes,
that's been historically the thing. Certainly the stock market's done very well recently, and it's at all-time high. So of course it's done well. But to have your own home, that's how you keep your family together. That's how you can be best off and put together a nest egg for retirement.
And if I can put in a plug here, I've got a series on buying a home in 2026. So let me refer you to that series. I go through looking for the right home to buy, how to make the offer, things to check on, uh, maybe even get an appraisal before you make an offer, because as I've pointed out, they will loan on the lower of either appraisal or contract price. So before you make that offer, and you're going to have to do it anyway, so you might as well go ahead and maybe get an appraisal. But
yeah, I'll plug the plug.
Okay.
Merrill's told me about what he's said. I haven't actually watched the podcast because I'm not a watcher. I'm a reader, but he's told me about it, and the advice is very sound. The only addition to it I would say is, as I was saying, you really, really want to look at the different mortgage options and try to talk to not the banker that's pitching them, but talk to someone like Merrill or someone who knows a little bit about finance you have. And maybe you do that sometime, is have a a podcast on the different types of mortgages and the risks inherent in those.
Well,
Just focused on mortgages.
in one of my reports, I did refer people to Fannie Mae, the website for Fannie Mae, and there is very good information there on different kinds of mortgages with different kinds of down payments. And so that's a very good beginning point, and I appreciate your point on that. Well, Grant, it has been fun talking with you today, and I appreciate this. I hope we can do it again sometime.
I'm a very busy guy, but
I know you are. I know you are. And I appreciate you squeezing me in the. So thank you, folks, for tuning in and tuning in today, and hit that subscribe button. And we'll look forward to seeing you next time.